Hey there, happy Tuesday, happy new year, and welcome to the first edition of SRT Live with me, Sean Richard, for 2022. Thank you so much for joining me today. And we're going to kick 2022 off with a bang. We've got a lot of great content to talk about today. Lots of data. Again, I geek out on the data, so I'm going to try not to go too deep on you, but I've got some great information to share that's going to give you some insights into the housing market, that's going to give you some insights into the mortgage market. And so we're going to talk about that today. So on the agenda today, we're going to talk about the 2022 forecast. What is this year going to bring for us in the real estate and mortgage markets? And then we're also going to talk about some of the data that we got last week. So every Thursday we get the jobs report. We're going to talk about last week's numbers, and we're going to look forward to this week, and we'll talk about how that has an impact on our industry. And then we're also going to talk about what is upcoming this week, what information is going to be market moving this week, and let's dive into it. So let's start by talking about last week's numbers. So last Wednesday, the National Association of Realtors put out the pending home sales. And what this does is this measures pending contracts. So these aren't closed homes yet, but this is measuring contracts on single family residence, condos, and co-ops, pending contracts. And so the pending home sales numbers, actually, let me go grab that for us. I had it written down and I went and changed the page. So let me go grab that. So pending home sales came out last Wednesday, and where that came in was a number that's not in front of me yet. Thanks for staying on this with me here. So I've got right here. So we actually saw some shrinkage in pending home sales. So we saw a couple of hundred, or a couple of thousand, I guess 100,000, 2.2 million homes, or pending homes, less last month. I guess we're down 2.2% from the previous month, and this measures month-over-month numbers. So we saw a decline. The consensus, the market expectation was a 0.5% increase, and we actually saw a decrease in that. So doesn't necessarily mean that we're moving in a negative direction, but this time of year, November, December, January, February, a lot of times we see a little bit of slowdown in our market, less homes going in the market, less buyers in the marketplace. So we see a decline in home sales, but that doesn't necessarily, it's not indicative of where we're headed as a market. Now, the bigger numbers are what we got last Thursday. Last Thursday and every Thursday we get jobless claims. And last week we got initial claims and we got continuing claims. So as a reminder, if you're tuning in for the first time, initial claims are people filing for unemployment for the first time. And so last week on initial claims, the market was expecting 208,000, and these are measured week over week. So we were expecting 208,000. We ended up with 198,000 for the prior week, which is very, very close to a post-pandemic low. We've only hit under 200,000 a very few number of times here recently. But unemployment is staying low. Fewer and fewer people are filing initially for unemployment. You've heard me talk about this. I talked about this last week. Pretty much every week, employers are hanging on to their employees. They're not letting them go at the same pace that they normally would. And so we're seeing less initial unemployment claims. This definitely speaks to the strength in the employment market. Continuing claims. So this is people that are continuing to file or renew their unemployment. And so we hit, I believe this is a post-pandemic low, an all-time low post-pandemic. So the market was expecting 1.868 million people continuing on unemployment. We came in at 1.716 million. So a post-pandemic low, speaking to the health of the job market, the robustness of the employment market. And typically when we get these unemployment numbers, when we get these jobless claim filing numbers, what this is really referencing is when we see a low number, then we're typically looking at a healthy economy. A lot of times a lower number is going to be positive for the stock market, for equities. If we see a higher number on these unemployment claims, then a lot of times we're going to see that's going to be bad for stocks. A lot of times we'll see the stock market or equities come down, and that may even cause interest rates to tick up a little bit. So we're seeing a very healthy unemployment market right now, very healthy jobs market where the unemployment levels that are being filed, the unemployment claims are coming down on a week-over-week basis and at relatively close to post-pandemic lows for unemployment claims. So pretty fantastic there. Looking ahead to this week, we've got a pretty big week ahead of us. So this is Jobs Week, and what that means is on Friday, the United States Board of Labor and Statistics is going to be issuing the National Jobs Report, which is really that measures the number of job creations month over month. And so this is a big one because on the same day that the jobs report comes out, because we've got that data, the unemployment rate comes out. So come Friday, we're going to see where job creation for last month was, and we're also going to see where the unemployment rate is. Similar to the unemployment claims, the jobs report is also going to give us a very hot pulse on the nature of the employment market, the jobs market. And if the jobs report comes out with higher than expected numbers, that's obviously a positive for the economy. And positive movement in the economy is typically going to drive interest rates higher. And we'll talk more about this here in a little bit when I get into some other topics. If we see a significant miss in the jobs report on Friday, then that could speak to a little bit of crack in the strength of the job market. And we could see that ultimately help bring interest rates a tiny bit back down because we have seen them rising lately. And we'll get into that. So that's on Friday. Now we've got a few key data points coming out before Friday that we want to pay attention to because they're market movers. So on Thursday, we've got the jobless claims. So again, every Thursday we get this. This is initial jobless claims and continuing jobless claims. Initial, people filing for unemployment for the first time, and continuing, people that are renewing or continuing to file for unemployment. So that comes out on Thursday. That's always a market mover. We want to keep an eye on that. And then on Wednesday, we get two key pieces of information. We get the Adp Payroll Report, which is a precursor to the jobs report. This comes out on the Wednesday prior to the jobs report every month. And this is ADP's take on where the employment numbers are. So the Adp report is a survey of employers, whereas the Board of Labor and Statistics, the actual jobs report, is a household survey. They're actually surveying actual consumer households. So, so it's a different perspective, and that does mean that there's almost always going to be discrepancy between the Adp report and the actual Board of Labor and Statistics report. But when these do correlate, that means we've got employers and we've got consumers on the same page as far as where the market is, where the labor market is. Also on Wednesday, the Federal Open Market Committee, the FOMC, finishes up their meeting. We're going to get meeting minutes from their last meeting, and so the meeting minutes can be a market mover. We already heard from Jerome Powell after the most recent meeting. And so the meeting minutes just gives us a little bit more insight, a bigger peek into the meeting that went on. And the market likes to read into that. They like to look at the granular information, and it can be a market mover depending on the nature of what's in those meeting minutes. So we want to keep an eye on that as well. Now, the big piece of our talk today is 2022. So it's finally here. What is 2022 going to bring for us, both in the real estate market and the mortgage market? And that's the $1 million question. And so I'm going to talk a little bit about today about two things. I'm going to talk about the short-term outlook, and I'm going to talk about the long-term outlook, because we're going to be moving in what is my opinion is we're going to a very different direction, short-term from long-term. And so I want to share something with you real quick. Let me go pull this up on my screen so that way you can take a look at this as I explain it. So one of the data points that I watch is the 10-year treasury, and then in conjunction with that, the 2-year treasury, and that makes up the 10-2 yield spread. And so let me share my screen with you here. Let's see. Yeah, that's it right there. So check this out. So you don't have to know a ton about what this is, but this is the 10-2 treasury yield spread. And so it's the 10-year treasury yield minus the 2-year treasury yield. So 10-year treasury represents long-term rates, long-term yields. 2-year represents short-term. So we've heard the Fed talk about what they're going to do this year from a rate hike perspective. They're anticipating, based on their last meeting, upwards of 3 rate hikes. So what does that mean? What can you take back to, if you're a real estate agent, what can you take back to your clients and help educate them? And if you're a homeowner, how does this impact you? Are you looking to buy? Are you looking to refinance? Are you just, wanting to keep an eye on your home value? How does this impact you? So the long-term rates versus the short-term rates is an important recessionary indicator. Because if we start to see the gap between the long-term rates and the short-term rates shrink, then if we look back historically, and I'll show you this here in a minute, but if we look back historically, every time that we've seen the short-term rate on the 2-year higher than the long-term yield on the 10-year, we found ourselves as an economy in a recession. And with the Fed talking about up to 3 rate hikes next year, what they're looking at hiking is the Fed funds rate. And if you're not super familiar with the Fed funds rate is essentially the overnight lending rate. So like banks lend money to other banks, other financial institutions on an overnight basis. And so the Fed funds rate is the rate at which that lending occurs. So the Fed is currently keeping that rate between 0 and 0.25. So very, very, very low. Well, if the Fed increases the Fed funds rate, which, as a reminder, is not directly tied to mortgage rates. The Fed funds rate, mortgage rates, long-term rates, right? 30-year mortgages is what you typically think of. It's long-term rates versus the Fed funds rate, obviously the shortest of terms, overnight lending. So what type of yield, what type of rates do you think that a change in the Fed funds rate would actually impact? And if you're thinking short-term rates, short-term yields, you would be 100% correct. So the 2-year treasury is likely to have is likely to be influenced more largely by an increase in the Fed funds rate than the 10-year treasury. So if we start to see some rate hikes in 2022, and the first proposed or potential rate hike would be in March. So let's keep an eye on the Fed meeting in March. But if that happens, then that has the potential to push that 2-year treasury a little bit higher. And although the 10-year will still get a little bit of a bump from a rate hike, it's not going to have as much of an influence on the 10-year as it is going to on the 2-year. So what we're looking at is the spread between the 10-year treasury and the 2-year treasury. And as you can see, back here in April of this year, we had a pretty wide gap. We had about a 1.5, 1.6 yield gap between the 10 and the 2. Well, what's happened since April of last year? Well, we've seen this absolutely plummet. Tried to make a comeback here right at the end of the year, October, November, and then it just took a nosedive here in December. And it's come up a little bit, but we're looking at, and I know this is small, so you can't really see it, but this is about a 0.7, 0.8% gap in the yield. And so I talked about what happens if this gets even closer. Well, let's spread this out. You can see here, this is the 1-year look. Let's jump out to the max here. And so this is the 10-2 yield spread over since, all the way back to I think 1970, 75, somewhere in there. And so look at what we have here. We obviously have a positive spread, and then it went negative, and then came back positive, and we had a negative spread here in the 90s, positive. We hit negatives right here in just before I guess early 2000s, and again between 2005 and 2010. And so let's just jump back to this one right here, 2005 2010. Let's think what happened in our economy between 2005 and 2010. So if you're thinking the meltdown that we had in the financial markets, you're absolutely right. And obviously not every instance of we call it an inverted yield curve, where the 10 goes under the 2. The 10 is yielding less than the 2. But if we look at these time frames in our economic history, every time that we've had this inverted yield curve, we had a recession that went along with that. And so if we look right here, you can barely see this. Let me do this. Let me do the 5-year, see if that's any better. Yeah, right here. So, right towards the end of 2019 into 2020, so what do we have there? We had a tiny inversion here, and we had kind of a miniature little recession in the economy at that point. So we're seeing the yield curve, the yield spread between the 10 and the 2 get closer and closer. And if we see that go inverted, then that could spell recession. It's been a great indicator in the past of a recession. So long term, as we head into the second half of this year, and when I say long term, really I'm talking about 6-9+ months. Short term is really under 6 months. So what does that mean for us as an economy, as real estate market, long term, over 6 months? So if we do slide into recession, number one, during a recession, home values typically continue to rise. Some people think oh, well, recession, home prices are going to plummet. Well, that's not the case, because think about what a recession typically, some of the characteristics of recession, right? So we have one, technical definition of a recession is negative GDP for consecutive quarters. So that's the technical definition of a recession, is negative GDP for consecutive quarters. So if we end up in a recession, we've got a shrinking economy, right? And so people are going to lean more towards a conservative approach. And so think about when you're taking a more conservative approach financially, what are you maybe not doing? Are you not making any significant financial decisions because finances are maybe a little bit more uncertain than in more economic positive times? So maybe you aren't making that home purchase, right? Maybe you aren't putting your home on the market and looking to make that move. So you've got a potential decrease, or I guess continuing decrease in supply, right? Those homeowners are not necessarily going to be putting their home on the market and making big changes. From a demand perspective, yes, you've got those same homeowners who aren't selling, they're not buying, but we are in the midst of the largest influx of home buyers in our nation's history via the millennial generation. And I've talked about this before, so you can check out previous updates to learn a little bit more about that, or you can always reach out to me and we can talk a little bit about that. But that's what happens in a recession. So if that's happening, then what we're seeing is demand stay relatively high, and we're seeing supply shrink a little bit more. And so supply lower, demand high, we get rising prices. Now, in the short term, here's what I think we're going to see. So we've seen inflation running red hot. And again, you can watch my previous market updates to where I talk about inflation, but inflation is running red hot right now. It's possible we may have peaked. So let's keep in on that. We've got some inflationary readings coming up over the next week to 2 weeks. But as inflation rises, a couple things that does. One, it erodes the value of mortgage bonds Because like if somebody says, hey, I'm going to give you, you're going to buy these mortgage bonds and it's going to yield you 4%. Okay. And so inflation starts rising. And so now new bonds are issued that are yielding 5%. Are you still happy with your 4%? Are you still, the money that you spent to invest in that bond is now not yielding as much as it could. And so it erodes the value of those investments. And so it drives the price of mortgage bonds down, which ultimately increase interest rates. Mortgage-backed securities and interest rates have an inverse relationship. So when those prices of mortgage-backed securities go down, interest rates rise. So the short answer is inflation is the enemy of interest rates. With inflation running so hot, that's why we've seen rates up so much over the last 12 months. I think we're up about 0.3%, probably a little bit more, probably closer to 0.5% since we've seen rates climb over the last few days. So inflation is pushing interest rates higher. Now, what benefits from inflation? And the answer to that is fixed assets, like homes, right? So if you've got a house and somebody is wanting to buy your home, right? Well, if money doesn't go as far, that means now in order to buy that house, you have to spend more dollars. And ultimately, what does that equate to? That means the price of the home is going to go up. Because, if I have, $100,000 and I'm trying to buy a $100,000 home, and now my $100,000 doesn't go as far, well, I can't buy that same home for $100,000. And I can't magically turn my $100,000 into more money. So the way that equation works is the home price goes up and I have to go get more money to buy that home. So fixed assets, the value rises. So this inflation pushing higher is driving the price of real estate higher. And I think everybody sees that, right? You see it, your clients see it. If you're a homeowner, you see the value of your biggest asset going up, which is fantastic. So inflation is helping us in one way. On the flip side, every time you go to the grocery store, every time you fill up at the pump, you're seeing the opposite end of that inflation and how it negatively impacts you. The cost of goods at the grocery store a little bit higher, gas higher than it has been in not too distant memory. So there obviously are some negative consequences of inflation as well. But in the short term, I believe that we are going to continue to see inflation stay high, which is going to drive interest rates higher. However, we could see maybe halfway, 3/4 through the year, we could see a little bit of a turn, and we could see the inflation start to cool off over the next 3 to 9 months. And if that happens, then we're going to see a cooling of interest rates. We're not going to see them rise as much, and we're going to see a cooling in appreciation. And that doesn't mean we'll see home prices drop, but it does mean that they won't necessarily appreciate in value as fast. But we've been in that. Here in North Texas, we're probably in 8 to 12%. Nationally, we're in that 17, 18% range, depending on which report that you look at, whether it's the Case-Shiller or the CoreLogic report. And we can't sustain those levels long term. We've got to come off of that. And so getting back to a single digit appreciation is perfectly healthy, and it's a very solid level of appreciation. So we're going to cool off. Homes aren't going to appreciate quite as much as they have been, but we're still going to see home prices rise. And that is a big piece to take back to your clients. If you're a real estate agent, if you're a home buyer looking at the market and saying, I'm not sure if I want to enter this market, I want to wait. We are going to continue to see home prices rise. They may not rise as fast as they have been, but they are going to continue to rise. And so these are the lowest prices that we're going to see for a little while. I personally think we could be looking at 3 to 5 years. There are some analysts out there that are predicting 10 years in our current real estate market. So I'm thinking, short to midterm is when we're going to see that. But that also means if you're a home buyer or a homeowner and you own or are about to buy a home, you're going to get some great appreciation in the coming years. So your investment is going to be sound, which is really exciting. So that's my short-term outlook, and as well as long-term. So for 2022, I think we're going to see a mixed bag. We're going to see inflation continue to stay high. Short-term, going to drive home prices up. at the exceptional rates that we're seeing now. Might cool off a tiny bit as inflation starts to cool off, and then long term, I think we could see that shift. The one thing that I haven't really mentioned also is, as a country, as an economy, we've been spending a lot of money. We spent trillions and trillions of dollars last year to help combat the pandemic and everything that was going on in our economy. And so the other piece that could potentially be recessionary indicator is that when we have that kind of spending in the economy, at some point, we're creating debt, right? Trillions of dollars of debt. At some point as a country, we've got to service that debt. We've got to make those debt payments, right? And so let me put it into a simple example that's really easy to understand and everybody can relate to. So let's say that you go out and you get a brand new credit card and you've got a $15,000 limit. All right. And you go out and you rack up $15,000. Well, you have all this economic activity, purchase. You're stimulating the economy, all this economic activity. Well, what happens 30 to 45 days later? You get a bill in the mail, and now you've got to start paying on that debt. Well, what happens to your cash flow when you start paying on that debt? Your cash flow comes down because now the money that you were using to pay all of your normal bills, to manage and maintain your lifestyle, is portion of that, a percentage of that is now going to service that debt, to make those payments. So your cash flow comes down, and therefore you have a shrinkage or a decrease in the economic activity, right? You had extra economic activity when you had that credit card spending above your normal economic activity. But then when the spending stopped, you had a temporary regular economic activity. Your normal, you get your paycheck and you have all that money to spend, but that bill starts coming in, and now you have a reduction in economic activity. And so that is likely what we're going to see as an economy. Is we've spent all this money, and we're going to have to start servicing that debt as an economy, and that's going to also have a negative impact on the growth in the economy. So in addition to the 10-2 yield spread that I talked about, the nature of economics with mass spending and debt servicing is also a potential recessionary indicator as well, and that could come to fruition in the second half of this year. So something to just keep an eye on, to watch. If I had a crystal ball, I'd own an island somewhere in the Bahamas, and I probably wouldn't be having this conversation with you guys. But these are great indicators to give us some things to think about and let us know what we need to be watching. So, some quick summary. Short term, I think we're going to see rates continue to rise a little bit, and we're going to see home prices continue to increase at a very great rate, with inflation going higher until we hit a peak. I think longer term, second half of the year into 2023, we could see a potential recession, but at the very least, a cooling of inflation, a cooling of appreciation, not negative prices, not home prices declining, but cooling, appreciating at a lower rate. And we could see interest rates come down a little bit as well, later this year, or maybe even into early next year. So that's my forecast for 2022. I hope you've enjoyed hanging out with me today. If you are watching this on YouTube, thank you so much for joining me. If you're watching this in the Powerhouse Real Estate Group on Facebook, that's fantastic. If you are a real estate agent and you want more information about the market, you want to make sure that you are doing the most business that you can do and helping as many clients as possible, make sure that you join the Powerhouse Real Estate Facebook group. There is the site down at the bottom of the page right there for you. And join the group, check it out. This Friday, I'll be doing a coaching video. So that way we'll be talking about ways to build your business. I'm excited to bring this information to you in 2022. Again, Happy New Year to you and everybody. Thanks so much for joining me. Have an incredible rest of your week, and I'll catch up with you next week.